Bottom right, Steve.
Well, you see, we got different bottom right, bottom left things because I've moved stuff around. Anyway, here we go. Let's see if we're recording. All right. Yep. All right, we're recording. Hi, Steve Hodgson and Nick Curry from Modern Asset Management. And tonight, we're going to talk about, how's that? Full screen?
Beautiful.
Oh,
Beautiful.
lovely. Took no time at all.
This is a beautiful presentation and topic that has been 2 years plus in the making. So no other screen is more beautiful for the right topic.
All right. And so this is a project that we went into. Well, let's do the. Is this a video we want to show?
The video actually should start. Maybe it looks like it didn't automatically start.
All right.
So it's 2 brokers in Los Angeles to sell this property, and the video is about 2.5 minutes long. It's put all over the internet.
All right.
Watched 13,000 times through Zillow.
Oh, was it? All right. So. All right. So. Let me go find it since we don't seem to be able to have it loaded. Alrighty, so I'm going to change my screen share. Here we go. So like we said, this is 1200 Linda Flora in the Bel Air part of Los Angeles. And we invested in this in December of 2016. And so
June.
Let's take a June. Oh, okay. Well, here we go.
Might be a little choppy, but the aerial footage is way better than looking across the street at those teardowns. Beautiful rooftop deck. Look, that's a $7 million view, right? How beautiful. Those were $30,000 sliding doors because of the remote. It was a $30,000 decision to make them push button. David says, that's amazing. We agree, David. We agree. And that's part of the problem. But they did an amazing job furnishing the place. We actually had to stage it twice at a $15,000 lesson learned. Well, the developer did. I think that's about the end of it, Steve. You could probably start the pitch.
All right.
That rooftop deck. Remember that rooftop deck? That 4th story at the top there. comes into conversation later. There's a lot of stories behind this. 2.5 years in the making.
Let's go back to the PowerPoint and start to walk through why we're here. So, nice idea, Nick, to start it with what we're what we're doing. So I'm gonna go back to the beginning. So this 1200 Linda Flora, 5-bed, 5.5 bath. I forget that. And we started this project in 2016. And just exited it, and didn't exit the way that we expected. So there was already a comment about how beautiful this is, and it was really easy to fall in love with this property. Being on site, I'll tell you, the video doesn't do anything to compare to standing out by the pool looking out into that valley with LA in the distance. It's just, I'm still got goosebumps, and I was a real pain in the butt to deal with as we wound this thing down.
You
Anyway.
you look across the valley at Jay-Z and Beyonce's house, right?
Mm-hmm. Yep. Yeah, they're over here. They're over here. Jennifer Aniston's down here. It's one of those things. This property was almost at the top of the ridge. The fires last year got as far as 2 doors down. Were smoldering a little bit. So this was scary last year too. So anyway, so in June of 2016, I went to a pitch. I had been to, I go to all the real estate meetups like everybody does, and I was at a RIA group down in Orange County, and I heard Ivan Oberon and Pete Asmus do a pitch for a couple of things, including this big project. At that time, I was trying to work myself back into being retired, and thought that passive income would be a really cool thing. In 2016, things were rocking and rolling. So I went to the pitch and heard the story of an experienced builder who had just sold an $8.5 million project about a half a mile away on the ridge. They had this house identified. It was the house that was torn down. Any of us would just have loved to have lived in. And the exit estimate was $1,400 a square foot. To say my greed button got pressed would be an understatement. We were offered a 50-50 participation loan, which is common in a JV, right? Or the greater of a minimum 20% annualized return. So this was a 20% note in second position behind a loan from Anchor Loans. The numbers they presented showed me like 60% loan to value and an $8 million appraisal, and I was hooked.
Official appraisal,
yeah.
Pre-construction.
Yeah, this was a real pre-construction after repair value appraisal based on comps in the neighborhood that we then found out later weren't exactly comps. This is a pretty large piece of property, but it's all steep hillside. There is no real usable space, where some of the comps that were used included half an acre of flat land, big circular driveways, guest houses, all that kind of stuff. This is people that live in this neighborhood are Hollywood elite, out of country investors, now.com folks. But anyway, so they raised $1.195 million. One of the first things I should have seen was, and I just glanced over it, is there were 10 points on this to the syndicator. And the 20% offer was certainly enticing. 10 investors put in between $40,000 and up to $350,000. We put in 200,000 to start. So we had a return that was looking like a 50% return, and it was going to be great guns, done in no time, on and on. So Nick, you think my date's wrong? You don't think it's June 16th? Think they started in December 16th?
It was it was June 2016, and it was because the initial house right before it was, because of the delays, the teardown was actually rented for a short period of time.
Okay, that's right.
From June to around, I have the teardown time frame in here, but I think it was March or April.
Okay. Yeah, so we got pushed back that way. We got pushed back by city planning. We had a number of things. So but they bought that house that was there for 1.8. They borrowed. They had a line at 3.2 million from Anchor, which is a good reputable company in the space, at 11% plus 2 points. So there was another signal there. 11%. That money now for the right experienced builders is 8 to 10. Lots of 9s are available if you've got the right loan to value. Yeah.
This was probably like a they do high LTV too, and that was one thing that the whole purpose of the second position loan was that the developer wasn't putting any of his own money into the deal.
Mm-hmm.
So they needed to raise equity, and so he needed to get his LTV first as high as possible.
Yep. So we had a 1-year loan, and that's one of the things we're going to talk about is, can you build a 6,000 square foot from the ground up mansion with a ton of engineering and get it sold in a year? No is the answer.
Oh.
Yeah, so it was not so shovel ready. The city had to come. The city required new engineering. Yeah, the permit. That's right. I forgot about the permits expiring. And there we go. We had to reapply. So anyway, 8 months in, they demolished the building, and then started to pour at 10 months in. All right. So the work throughout, and I put this in, it's a little out of place, but the work throughout. You saw the video. This was a beautiful product, and but we'll talk more about how that plays out in terms of value. So they, as he's bouncing along, he decides to be competitive with other product that's coming on the market, and he needs to add a rooftop deck. And in order to get to the 4th floor, he needed to add an elevator. Right.
And the rooftop deck was going to add how much to the value of the house, Steve?
It was like a $300,000 or $400,000 value add, according to what we've been told, what we were told, and in fact, it turned out to be nothing. It was completely immaterial. The big issue, though, is that it required more engineering and more money and more time. And so let's think for a minute. We've got an 11% loan on $3.2 million. That means that you're eroding the equity in this property to the tune of $35,000 a month, plus more for taxes and insurance and all that. So you're probably eroding $40,000+ a month. So as we'll find as we keep going, I'll let some of the secret out. Spoiler alert: Anchor made a lot of money on this project. So we don't meet the year deadline. Pouring the concrete for this was just astonishing. The engineering of these pylons to hold up a pool 40 feet out in just nothing, out in air, was remarkable. So every time they did an extension, they do a 3-month extension. They'd toss on another point. So there's another 30 grand, and then they'd keep the clock ticking. But the project starts to come together. The builder is living on this. This is his one and only thing. So, you know, to Bob's credit, this was not a project just sat by the wayside. Was he was doing other things. May of 18, we put in more money. So this is, you know, less than a year ago, and I'm still hanging on, believing in a $7.5 million, seven and change valuation, and knowing that there's $5 million owing on the property. I'm still thinking I'm gonna, you know, I'm gonna make a 30, 40, 50% return. Um, so. Um, so, like I said, we liked it so much, we bought out another investor who was scared, thinking that, you know, we're going to pick up a little money there. And his loan is due. He's short on construction money. He's tapped out his 3.2 line, and we take a third position for an additional $300,000 that will carry the project for 5 or 6 months. The one of the values of that, and it was certainly, there was two things. One of the values I thought at the time is that then gave me some control, because I didn't have to go through the other 9 investors to try to force him to sell. But really, I was looking for, we charged a very hefty interest rate on this loan. And again, it's the greed button. Knowing what I know now, when there was a cash call for more money, I would have gone the other way, and I would have started foreclosure action right then and there. The purpose of jumping on the foreclosure action was to stay ahead of the $3.2 million anchor first position loan. By this point, I've either come to my senses, or I'm coming to my senses, or deciding that I just hate passive investing.
So the 300,000 thrown at it just to get it done. At this point, the project is 2 years in. Everybody's wants their money back. Some people are willing to take a discount to whatever they're owed, and 2 years in, and the project still isn't finished, right?
Right. Yeah. So we go on the market. The broker that he chose is, I've talked to the lead at length. These were the right people to show this property. The builder set the exit price at 7.8. The brokers were yelling at him that it wasn't going to move for more than 7. And there we sat. So he gets a lowball offer at $6 million. Doesn't even present it to his investor partners, because there's no money in it for him. Listing comes and goes. They show it to lots of people. Well, as many of lots of people as you're going to have looking for $7 million property. And everybody comes away. It's a beautiful house, but they can't make the leap from the house next door. Was a project that finished a little bit ahead of us.
Mm-hmm.
Smaller, nowhere near as nice, but still magnificent. That sold for 5.5, I think.
Down the street, ended up selling for 5.5. Those people looked at 1200 Linda Flora, loved the house. They just thought the $2 million difference in value wasn't there, so they went for the lower option. It was a lower quality, and still $5 million house is absolutely beautiful. Yeah. But there were two new construction comps within 2 lots on either side. One that construction finished before, and was listed at the same for $1,400 a square foot. So at that time, we were still sane, because other people were marking their prices at the same level.
Right. Yeah. So we were pricing at that point at about $1,300, $1,400 a foot. the market taught us that market price is somewhere between 1,000 and 1,200. And so end
I,
of the year. You got a comment?
I think yeah, the feedback, the market during that time, um, it was it wasn't a house for everybody. Steve, I remember the broker telling us the modern style of that house is going to be someone that moved down to Santa Monica and cashed. You know, when Twitter went public, they cashed out, or it's a young tech person, or it's not a. There's a very specific market, so that
Yeah.
they were the right agents, they were the right buyers, and it's more like art than and subjective value rather than blue book and
Mm-hmm.
comps down the street.
Yeah, yeah, and that's the same thing in subjective value about the finishes too. I can't tell the difference between $100 and $120 a foot marble. I have no idea. But so this slide. So just as time's running out, now the extensions are month to month with a half a point every month. The money is just starting. We're bleeding, and the developer is hanging on to. He wants his $7 million. He starts chasing refinances because it's the pressure's on. He's servicing this debt. He's having to make the monthly payments. It's getting really scary. So the end of last year. We had this we had this thing where the brakes got put on, the fear came out, and if you look at this chart, there's only a little tiny inflection point on the green line here in the corner. The market just changed this little tiny bit, and the world stopped rotating. I mean, it's just nothing happened.
Especially the high end market,
Yeah,
from what we're
yeah,
hearing.
yeah, yeah, yeah. So here we are sitting. We're not on market anymore. He's trying to sell it himself. He's got nobody interested. It's ugly, and he won't budge off of the price because he's looking for a good appraisal so he can get a takeout. So that was the. So what did I learn? He wouldn't price to market. The two reasons that real estate prices change are greed and fear, and that absolutely happened. The builder didn't put us first. So while we talked all along about being partners, he was taking care of himself, and that's the way lots of people work. That's not the way we work. Our investors eat first. But we didn't. We were too passive and just rolling along. But like I said, all the profits disappearing, and these $40,000 a month cost of keeping the project going.
His profit, we
Yeah,
thought. His
yeah,
profit.
his profit, right? His profit, and then we start dipping, and we're starting to get into our profit. So investors are howling. People having conference calls. People are yelling and all that, but nobody's taking any action. Nobody's taking charge. Um, so I just went through all of this. He's paying the interest as he goes. So Nick and I wrestled for a long time over this point, months of let it ride, see what happens, and I'm hammering at no, it's too late, we got to go. And I'm not saying that to blow my own horn. I'm saying that because the lesson is hold people to the contract that you signed with them. The Garachi law firm did this loan agreement, and it is onerous. It is bulletproof. It is full of recourse, and we sat back and let the builder drive the finance side of this, and that was the mistake. We're supposed to be money guys, and we didn't act like money guys. We acted as we acted as we acted. So December, we sent a demand for 1.8 million. Noticing the clock told February, just a month, 5 weeks ago. notice of default is served, and magically, well, not magically, because he's been working at it really hard, he finds a new loan, and he's able to recapitalize the property and get $5.7 million out. So I'm, at this point, we're all very happy. But if I had done that 8 months ago, I think we would have been happier, right? Wouldn't you say, Nick?
So it's important to say where our basis was, and we needed 6.2 million essentially for the preferred return at that point to get paid in full. So we weren't even looking at the 50-50 profit share because there was no profit, or like pushing the refinance option because he wants to hold the property, and that's great. But the investors wanted to get their money out, and 5.7 million was a concession to what was fully owed at that point. So the refinance was shopped with a half a dozen lenders. There's not a lot of money taking risk at the $5 million plus level. Their valuations, to no surprise, came in here and here and here and everywhere in between, from the half a dozen lenders that he got. We were there. This was the best offer that was given to refinance out the property. So the investor group decided to take it on terms.
Right. So let's see. Do we cover that in the next slide when we go to the next one? How did we get out?
I think so. So nobody was taking action. Steve and I were playing good cop and bad cop, and it was the right thing. It put the pressure on to make something happen, and the lenders then saw that, the developers then saw that, and it wasn't just a request for the property to be sold or the price to be dropped, because that was requested several times. So 5.7 million. You can explain what it did.
Yeah. So we pushed from our third positions, and again, since we didn't have consensus in the group, so we filed from our third position. We immediately the next day filed for the second position to make sure that both loans were in line ahead of a foreclosure action by Anchor. We were not looking to cheat Anchor out of their money. There was no way we could have done that. But again, the time was up. Time was up. What we negotiated out was what we believe is an achievable exit. The builder needs to eat off of this project if he can do that at all. So he owed $700,000 in unpaid interest, and we offered that. We took that down to half, the $380,000, and then built a discount plan for him that encourages him to sell the property right away. We cut that half in half if he sells the property in the next 2 months, and then each month it goes up after that, back up to the 380,000. If the property doesn't sell in a year, then then the original 16% default rate that's in the note and the whole $700,000 is due. But I think that's moot. If this property sits more than 6 months, it's going to be upside down, and it'll be a short sale.
No longer new construction at some point as well.
Right. Oh, that's right. Along the way, he put a renter in it. He put a renter in it for 4 months to get his monthly interest covered. The house rented for $35,000 a month. So that says something to what its value really is. So he's got 4 months of interest reserve, which gives him some time to price to market. If he prices to market, sells at 6.2, we'll pick up 200,000. He'll pick up 200,000, and everybody moves on. and we hope he's successful. I mean, he's he's very easy to like as a person, and so we don't wish him ill. We just know that he's a builder. He's not a finance guy, and he's a dreamer. And we need to be we don't need to be dreamers anymore. So this was the this is probably one of the lessons.
So 2.5 years, no return on your money. Here's your principal back and some future residuals if and when. Hopefully that doesn't turn into an if. And not to consider the lost opportunities on that capital, but just no earnings.
Right. Well, and point of fact, we borrow money to fund deals, and so we're running 10% negative because that's what we pay sometimes. So the lesson learned is don't fall in love with promised yield. And you see me, I'm an old gray-haired guy, and I keep fighting this lesson. And we didn't go through enough of how am I going to get hurt in the beginning. I didn't look enough at that. I didn't pay more attention to the counterparty risk. I didn't do a thorough enough investigation on all the people pitching this deal, make sure that they had success, and to see what happened with projects that went south. I found out after the fact that there was another investor in this group that lost money in a deal where the first took it back and the second was wiped out. And I was like, why would you be doing it again? But so, but why? And talk to me a year from now, and I'll probably have tried to do it again, but Nick will stop me. So punch holes in the pitch. I said, I believe this thing right from the renderings that this was just perfect. I drove up there, I looked at it, and I said, oh yeah, this is exactly right. And it is. There are 10 other projects on that ridge is, about 5 miles circular. There's 10 other projects actively on market right now.
One for 20 million. That's probably 800 yards down the. Yeah. It's not too far, but it's a different painting. It's a different canvas. It's just these are not. It's not a subdivision where they're comps. They're just not comps.
Mm-hmm. Right. Yeah, you can't square foot to square foot doesn't work. Don't chase yield, chase return of capital. And I what did I write? I said I should keep typing this till I believe it. I'm chasing a development project right now, and that's gambling. But it's sure it hits all of my buttons. We're looking at much smaller dollars, more actually pure blue collar workforce housing, and that's something that I understand. I like my little Pensacola rental pool. I like the stuff we do in Gary. If you want to work in Gary, Indiana, you can buy stuff for nothing, right?
Because everyone will always need a house, right, Steve?
Yeah. Well, as long as there's people in town, right? But when people leave, so the capital structure was not right for this. He had a 1-year loan, and it took him 8 months to break ground. So it's understanding that timetable. We didn't, and also we didn't go back to the contract and looked at all the hammers that were in there and started applying them early. If we had done that early, we would have gotten out of this passive thing and gotten into dictating terms on the loan. There were plenty of things in this loan that could have been used to force him to take action a long time ago. So, he held to all of his deadlines on construction. I mean, once he got rolling, but it was, again, it was. There's no whose fault is it that you got the early delay, but permits in hand, not expired permits in hand, would have really helped. Let's see. Yeah. and then hold your partners accountable. Foreclosure, like you said, foreclosure is a tool. It was not the last thing I wanted was for this thing to go to a sheriff's sale and having us wind up owning it and having a service now would have been like a $4 million debt. So
the developer was given warning after warning after warning that this is what we're going to have to do in order to take control of the asset to sell it if the price is going to be reduced. And he didn't want to reduce the price because he wanted to exit with a refinance. All of that made sense, but it was, of course, serving his interests. There would probably be no profit if it was taken back and sold at wholesale. So the hitting the button, 8 months before that, when construction was finished, and he didn't interrupt construction, that would have saved 8 months of carry costs. $300,000 that just evaporated.
Mm-hmm. Mm-hmm. Yeah, and so the winners on this was the bank, right? Was Anchor. And why are we in the lending business, Nick? I looked at a count today, or what do we have, 880 active loans, and we keep talking about us focusing on what's most important, but like I said, here we are talking through. I do this not to pitch anything, just to show you that after 30 years experience in this game, we still do this. We still do this.
I think that the biggest lesson I learned that you hit on with Gary, Indiana being the point is everybody needs a house, but not everybody needs a $5 million house. It's a luxury. Mm-hmm. And therefore it is built either custom by somebody for somebody
mm-hmm.
with the exact furnishing, the finishings they have in mind, or you're building it to hopefully appease the masses. And I think they did a great job of doing that, but it was making sure the right people get in, and it was on market for such a short period of time that they didn't get a chance to really show it as much as they could have and should have. But we like the 1/10 of this, something that rents for $3,500 a month and not $35,000. It's just when housing is a necessity and you're at an affordable level, and this is this is off the charts on the affordability index if you're actually if you follow one of Robert Campbell's principles on affordability.
Yeah.
This is so far off the charts. It's a risk.
Right. But it's all it takes is Google, or what it takes is Twitter or somebody else having their IPO and suddenly make 1,000 new millionaires, and somebody will come in and snatch up this beautiful party house. I wouldn't live in it. I'm too old. It's just the stairs would have done me in.
Too big.
But it's a magnificent place. And for me, there was also, I think, a certain amount of ego in this. I'm doing $50,000, $100,000 rent to own. I'm buying $30,000 mortgages. I'm making $2,500 unsecured loans, and this was I talked myself into. I was balancing my portfolio with some more real estate against the unsecured subprime loans that we do. And really, I think part of this is I was, look at me, I'm a big time LA investor. I could have done how many East LA fourplex flips could we have done with that money? So and not I like to mention that what were we doing? It took 6 months to buy, build, and sell a $250,000 house in Pensacola. Could have done 2 of those. That would have made 20%.
Yep. All lost opportunity cost.
Yeah. Yeah, and I would have had the, I, I don't. A lot of what I do this for isn't to count the, the balance sheet at the end. I do this for there's a lot of satisfaction and completion of a project, which includes not just finishing it but selling it and handing over keys to a happy homeowner is a big deal. Um, and we got that little house down in Pensacola that we're having trouble with the taxes and insurance. The borrower didn't understand. I got an email today. This was a $65,000 sale to somebody that didn't know nobody would ever sell this guy a house. He hasn't missed a payment in 2 years, and his insurance went up because there was a hurricane and his insurance doubled, and we just couldn't get him to understand it. Well, finally today, with a face-to-face, he understood it, and he's very grateful. He's got kids with their own bedrooms, and he's got his own house with a backyard, and he's not living in a two-bedroom apartment anymore, and he's thrilled to pay a $650 a month mortgage payment. I said that was a $65,000 sale. My basis in the house was 35. There was 30. There was a 40% upside in it. And why couldn't I be happy with that? I think I should go be happy with that.
Just takes more time to do a lot of those, but
Yeah.
there's more satisfaction. There's more need at that level, and like you said, really, it's a feel good factor to be able to help somebody at the end of the day. The emotional aspect of this, where I'm very quantitative based. I starting to work with Steve after this deal took place. I believed in this from a quantitative standpoint as far as I could see. 50-60% loan to value, no problem. We took some of the corporate money, doubled down at a discount, and ended up getting all the principal back. But it was a Picasso, and I don't know what those are worth. It's only values what someone pays, and what's the is it value values what you pay.
Yeah. Yeah.
And
yeah. So anyway, I thought that this would be a good story for this month because we've touched on this project a couple of times over the last year and a half. We've been doing these, and I wanted to show people how the story ended. We still have this little dangling. Maybe we pick up another $100,000 in back interest along the way. I'm not counting on it. But capital's back. It's going back out to other more meat and potatoes kinds of things, and on to the next thing. So anyway, anybody want to jump in? Anybody got any questions, or we can wrap
posted up? The corrected quote in the chat. It was Warren Buffett who I was trying to remember.
Oh, there you go. Yeah.
Price is what you pay. Value is what you get.
Absolutely.
And so it's value is just subjective at that point. What's someone's willing to pay. The price of $50 million Ferraris on the auction block is also sliding. I'm a car guy. I follow that stuff, and they've slid 30%. And why? It's value. It's subjective. The people who wanted those have bought them. There's very few to go around.
Mm-hmm. Yeah. So anyway, we're gonna keep playing with stuff that more people want, right? But anyway, here we are. That was Modern Asset Management story for the month. Always looking for topics to talk about in the future. I'm probably going to talk about opportunity zones or maybe partials again. Those are the things that I'm working on of late. I could be talking about this office building we're in contract to buy right now. That I'm just a little short. I'm so close to making it work. So Nick and I were talking about, well, I'm a little short. When I say a little short, we were 300,000 short, but we found that earlier today. But anyway, so I wanted to thank everybody for coming. And David, that's
You're
exactly
welcome, David.
that's
Absolutely.
exactly why we do this. I'm not here selling anything. I'm talking about the things that people don't talk about. What's not perfect. So anyway, I really appreciate everybody being on. We're going to put this up on YouTube tonight. So if you wanted to share it with friends, look for it under my name, Steve Hodgden. And like I said, it's out there for people to use. And thank you, Nick, for hanging in today. And thanks for the hard effort at the shop today. You did it. You got a lot accomplished. All right.
Thanks.
So,
Thanks,
all right.
everybody. Thanks,
All right.
Steve.
Thanks. All right. Good night.